What I'm going to talk about is a lot of fun and is quite different, and I want to thank everybody for attending. And it is really different, especially for people who are experienced traders. The title here, which yourself at the Paycheck, just marketing slang, if you want to call it that. I don't do marketing. I do the stocks. And what it is here's our disclaimer. You can read it. I'm going to read the first half of it to make sure I don't go to jail. Forex futures, stock, and options trading is not appropriate for everyone. No kidding. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the weekly paycheck or related methodologies coming from Michael Shulman or system or the information in this presentation will generate profits or ensure freedom from losses. Okay, we're done. The focus in what I want to say is the word income, but it's for cash. From a cash that can be used for income or cash that can be reinvested. It's a distinction with a difference, and in my advanced coaching programs, I run 3 services. We find the people in the basic service, maybe 50 to 75% are using their weekly gains or monthly gains for income. They're extracting. In the advanced services, it's the inverse. About 2/3 are reinvesting it. So if you're struggling to get consistent cash or income, and you're the kind of investor who has some pool of money that is still, oh, I have to use it for income money or I have to use it for cash, and you're basically getting no yield. And if you're frustrated by losing money trading options, which most people do, it's a reason you may be here today, is to find out how you can make money trading options. And you're hunting for, you're not trying to get doubles every Friday. What you're hunting for is consistent annual returns or consistent quarterly returns, or as a paycheck. So the next 30 minutes or so, and I can net time models, which is really good because we're going to do a little bit of training here. This gets have a little bit. I think you'll really be interested in the canned. If you ever subscribe to my services, you'll see that the condensed rails that come bundled with the packages, this is a condensed version, and now you're going to get the slightly less than condensed version. I've developed, it's a really simple trading strategy, and if you're in retirement, it's to protect your, if you have a protect, the first thing is capital protection. The first thing is to eliminate risk. Depending on the size of your portfolio and how much you allocate towards this, my advanced programs are designed for people really with $100,000 in income, but this works, with capital. This really works if you have a small account, $15,000, $20,000 account. And it will put, and we'll show you the last 4 weeks of trades with no editing. I mean, just the last 4 weeks of closed positions. And if you want to end all the frustration you're feeling with cash and income and the uncertainty that happens in certain markets, I think what you're going to learn will take you no more than a half-hour a week, probably less once you get adept at it, in terms of doing this on your own or doing this following one of my services. When we do surveys, this is all based on survey information, they're averaging over $250 per week in income. I'm not exactly sure what the, I can tell you what the average capital return will be. You'll see those charts later, but I'm guessing this is somewhere between a $30,000 and a $50,000 portfolio. In the last 4 weeks following the strategy, meaning the strategy plus the specific recommendations that I make, the average was $415 per week, and you'll see the capital requirements in a moment. But that's over $20,000 a year in additional income that I'm assuming you're missing out on, because I do take a different approach in a different way to doing that. And I think it's time, to change missing out on things. If you do buy options or do spreads or all this sort of stuff, one technical bump in the market and your capital takes a giant whack, or it takes a mid-sized whack. But when you're looking and focusing on cash per week or per quarter or per month, or income per week or per quarter or per month, you can't do that. You just cannot. So it's time to change that. And I was described heroically. I am a 30-year veteran. The first 15 as an amateur. I'm meaning an individual, not with inside the industry. I entered the industry as a published advisor in 2001, and what I did was the first 5 years was institutional investing, selling alongside our salespeople to hedge funds and mutual funds. Sell short, made in America. I write articles regularly, and fortunately, knock on wood for them, as well as for me over the last 4 years. My services have been quite successful. I have no complaints. Life's been good. And I've, had the enjoyment of knowing thousands of people have probably benefited from all the things that we've done together. And since 2010, when they were just a small universe, I started selling weekly options, not buying them. I want you to look at that word selling. If you were thinking there's some exotic strategy coming in the next 45 minutes or what have you, we're talking about the sucker's bet, and you're not the sucker, okay? You're the house. And you're selling weekly options. We're going to focus on weeklies. This strategy obviously applies to monthlies as well. But it's about selling options, not about buying them, not about constructing spreads. About 4 years ago, actually more, knock on wood, 5th year, my sons, I have twin sons, they graduated about a year ago. They went to those really expensive liberal arts colleges, got marvelous educations, ignore the headlines about these places are a ripoff. I'm proud of both of them. They did really well in life from their education, but I didn't want to dip into my savings, and given that colleges were running $65,000 a year per kid, $130,000 a year per kid, I had saved about half the money, and I needed to come up with the other half without dipping in to a retirement account. I wanted to skim the cream. So, on my own, before we published with Traders Reserve, I created a simple, repeatable system to put cash into my account initially every month and then evolved into every week without risking the capital in my portfolio, without technically causing any risk. My target was very different than when you hear about options. I was targeting 1.5 to 1% a week. Every week, mark it up, mark it down, didn't matter. This is what I wanted and had to do. And my need for income was not based on moves in the market, so the strategy and tactics I developed, of course, had to be independent of the market, and to this day they are. Now, at first glance, you think it doesn't sound like that. This is a weekly income goal. This is the hardest thing for experienced traders to grasp. It's the most emails I get. It's the most confusion from hardcore traders is, no, I'm only making 50 or 100 bucks. Well, you do it 52 times a year. A $50,000 portfolio pulling in 0.5 to 1% of income a week, and I mean cash or income, is making $250 to $500 in cash. That's $13,000 to $26,000 on a $50,000 portfolio in an extraordinarily low risk approach. So the first hurdle you get over if you're an experienced trader, or if you've come to these kind of training seminars to say, well, how do I get 40% in a week? This isn't it, but this is better. It's considerably better. And if it's a larger portfolio, $100,000 portfolio, you're looking, now $52,000 a year would be an exaggeration. I think I had one subscriber who did north of 50%. But for the basic service, people target really around 20 to 25. I recommend 18 to 25. Performance is around 29. The advanced coaching services we do, they're higher than that. If you have a smaller portfolio, even a $10,000 or $20,000 portfolio, if you're efficient with your execution, this works. It's in market independent, and it's really independent of the size of the portfolio that you have. And it's all about generating cash that can be used for income. So stick with the presentation. It's about selling. It's about taking suckers' bets and work in the bank. And we're going to go forward now. We're going to get into specifics. I want to do a little street credibility here. This is the last 4 years of the service. Okay, we're not talking about the service specifically for the next half hour, but to show you that this approach of selling options and targeting 0.5 to 1% a week, this is the important message. Whether you subscribe or not, whatever, this is the important message. Take those option buyers' money, and this is what happened. And wins means break even or a profitable trade. Those numbers don't lie. And so that includes the Congressional Meltdown, when some lunatics in Congress decided first they were going to renege on the national debt, then they just shut the government down. This is the Greek crisis, which was the first one was actually at the same time. This is all the oil price spill-off last October when the market was down 5-7%, depending upon which index you travel with. It's all through that. It's market independent. And here's an unsolicited quote. I have good email relationships with many of my subscribers in the coaching service. They're very important to both of us. In the basic service, it's the same thing. I answer all my emails. This is unsolicited. It's well worth the money. It's hard to believe how good this is. I started with 200, now 300,000. We recently did in-person seminars in Florida. Made my year. One of the people using these tactics lives in Colorado. Grandkids and kids live in Michigan. He bought a house Michigan, which if it's Detroit, it could be cheap. I don't think it is Detroit, because of what he's earned by using this approach consistently for over 3 years. Hopefully I have your attention. So that was one student, selling weekly options, and I said selling. Before you went off thinking you've lost money with options, and most people who buy options lose money, think about it. 80% of 85, really, it's closer to 85 than 80, of the time options expire worthless. If someone is losing the money, if 85 out of 100 positions lose money, who's making the money? It's the option seller is making the money. And if you do it with frequency, you're making a lot of money. Now, with all due respect to other things that you may be doing, and if there are any advisors on the line, if you're a real option trader, you're probably doing it the wrong way. You're trying to hit a home run, 100%, 300%, 800% winner. My first big options win, I made a year's salary, and then I gave it back, which a lot of you probably have experienced as well. You go for home run, you're buying an option. But here's what the option buyer is really buying. You're the right to spend capital in the hopes of getting a profit, perhaps a spectacular one. You're buying risk at the expense of reward, meaning the risk is higher because of the potential for expiration, worthless or very low because of time value. They're buying insanely ferocious time decay. This is extremely true with weekly options, which is what we're mostly focusing on today. You buy a weekly option on a Wednesday, middle of the day, which is typically when I like to sell them. You have 2.5 days. And you can imagine the acceleration of time decay in those last 2.5 days. And best of all, you're buying options that expire worthless 85% of the time. And I said best of all because they're buying options from you. They're buying options from me because it means the option seller stands to profit that 80% of the time. So the right way to trade weekly options, this is true for monthlies, today we're talking about weeklies, is to sell them. Not buy them, sell them. First of all, when you get an option, you sell cash. Cash goes right into your account. You don't have to wait till expiration. You don't have to wait till this. You don't have to wait till that. It's in your account. The buyer is literally handing you money so that you are now managing profit, while the buyer, not you, is left to manage the risk. When you sell an option, you're getting the advantage, a weekly option, of that insanely ferocious time decay. Now, time decay we're going to get into in a moment. Time decay, meaning let's say a stock is $100, is $20, and you've sold somebody a $20 put. The stock is a 21. It's a $20 put, and someone paid $1.50 for it. It means it's 50 cents in terms of the intrinsic. Anyway, I'm getting ahead of myself. My point is this: is that weekly options expire at the end of every week. I know I have 90 minutes now, so I'm trying to squeeze some stuff in, which I shouldn't be doing. Weekly options expire at the end of every week, and in a moment, I want to show you how to use this in time decay to your advantage and to take advantage of options buyers. You get to exploit those 80% of people. The odds are in your favor. When that option expires worthless, you receive the money. It could be the previous Friday. It could be 2 weeks before. It could be that Wednesday that I like to sell on. You're keeping the cash. And here's something very important. It's a one-way trade. When you're selling an option that expires worthless, you're only paying one commission. And it's even get better now because of the popularity of options. Many large, even some small online brokers, if an option is a nickel or less, you can close the position out either for free, no commission, or half, my broker's half commission, or little flat rate commission, which is considerably lower than the normal one. So there's things in your favor, even if you have a small account and you're trying to be efficient with your trades. So I'm asking you to stop swinging for the fences, stick around, and let's talk about generating weekly cash income, weekly cash to reinvestment each and every week. And makes Friday a special day. It means you personally have created your own paycheck. You're not waiting for a stock to appreciate. You're not waiting for a dividend check to come in. And as I said, in the past 4 weeks, based on a hypothetical but average trade size, subscribers to the basic service that I offer, which is by far the most popular, have made $415 a week using the strategy. Now, as I said, option traders speculate buying options. I don't speculate. It's at 0.5% to 1% a week. I accumulate cash every single week. What you're doing is when you're selling an option, you are selling people risk in return for their cash, which is pretty cool. And they turn over their cash, you turn over the risk. So the instant cash and the risk transfer combine, okay, to really help you protect your capital. Now, some of you who are experienced are thinking, hey, wait a minute. You've sold a put. It's a right for someone to put you the shares what if the stock goes down. Well, we don't have time to get into it today. There's something called rolling. My broker screen has the term roller on it. And remember, selling a put is the same capital risk as buying the shares at that price. So it's the same thing in terms of risk of buying an equity that you believe in. And you should not sell a put unless, of course, there's an equity you believe in. This is a fundamental-based approach. This is not a chart-based approach. So the protection of capital here is wonderful. You're getting the instant cash. You're transferring risk to the buyer of the option. They combine with that fundamental approach of protecting capital. The capital risk you have is no more than buying an equity at a certain price. And there's also simplified trade management. You're managing money in a position where you already have the cash in the bank. The buyer is managing the risk, exogenous events and so on, and time decay. And even with a target of 1/2 of 1% a week, you can get really, really, really high returns. And it's simple and it's repeatable, and every Friday can be a wonderful, wonderful thing. And it's how everything went very well in college. So here's some specifics as we go forward. First things first. In order to sell a put, you must have the capital on hand as collateral. In the unlikely event you put the shares, meaning a put is a contract where you sell someone the right to sell you the shares. So if you sell a $16.50 put on Bank of America that expires Friday afternoon or over the weekend, they can, anytime they want, after they've purchased the put, they can force you to buy the shares at $16.50, no more, no less. And that means that there's no such thing as a naked put. These are cash collateral puts or margin collateral puts. The term naked put, I think, was invented by brokers to scare people away from doing this because it's too complicated for most of the simple-minded brokers I've met. And the bottom line is there's no, it's not like shorting a stock, which I did for many, many years, where you have an unlimited liability. You sell a $16.50 put contract, that means it's controlling, you have to buy 100 shares if someone wants you to. That means you have to put up $1,650 in collateral for each contract that you sell. And a call option is the inverse. You must own the shares, and it's 100 per contract. And if you sell 100, you sell a call option on Bank of America. That means you have to have the shares in your account before you do it. And you need at least $10,000 in capital. It'd be preferable to put more to work, but you really can't do this with less than that. And you can do this in an IRA. Occasionally I get a new subscriber goes, my broker won't let me do it. It's a matter of filling out another form to go to another trading level, or it's a lousy broker, and they have to move on. And now let's get specific. Selling weeklies is no different than selling monthly options, except, of course, for their duration. The majority of weekly options that you will see, especially in terms of liquidity, meaning they're actually trading, exist for just about a week. They may open they might open this Thursday to expire a week from Friday, but some open weeks in advance. Some of the larger cap stocks, Apple and Gilead Sciences and whatever, you could buy a June week 1, you could sell a June week 1, a June week 2, etc. Regular monthly options expire on the 3rd Friday of every month. Now, my approach, of course, is to sell options during the week they're scheduled to expire. And the universe is quite large, but as you might guess, that 3rd week, the entire universe of monthly options opens up, and I treat those monthly options as weeklies during that week. And as I said, more than 80% of all the options do expire worthless. The buyer loses all their money, and you keep all the money. It's a wonderful thing. The zero commissions is something I alluded to before. This is very important a cash management strategy, especially in a smaller account. If you only have a one-way commission, this is one of the reasons that some of my subscribers prefer weeklies to monthlies, because in my service and in your own portfolio, independent of whether you ever became a subscriber, there are fat premiums, obviously, on monthlies. Decay is slower, but something may happen with the stock in your favor, and you may close out the position early. We just did it this week a couple of times. The last couple of weeks, and that means you're paying 2 commissions. But the typical weekly that successful expire is worthless, and you're only paying that 1 commission. And you really need to do it. It's instant cash, it's lower risk, and it's fewer commissions. So what's the essence of the risk that I'm talking about? It's something called time decay. And what happens is time decay accelerates over time. So if you've sold a put on a stock that's a $30 strike price, the price where they can put you the shares, and the stock is at $30.20, and you do it on a Wednesday, and you've gotten 50 cents for that put, it's going to be, and the stock doesn't move, it's going to be 25 cents on Thursday, and it's going to be 15 cents on Friday morning, and it's going to be a nickel at 2 in the afternoon, and it's going to expire worthless if things work out. So this decay accelerates, as you can see in this chart, as you approach expiration. It's one of the great advantages of weeklies, is you're catching right here as things begin to really accelerate, and it starts to come down. That number is probably now about 420, and it's stocks, it's ETFs, and it's indexed options. There are weeklies on many names. And one of the things that you look for, you have the time decay, but you also need volatility. Many of you may be familiar with implied volatility. The Greek that they use is called beta. That's not that important when you're doing weeklies. Index traders love these things. For us, it's meaningless, and it truly is you want to work backwards from the premium, meaning how much money you can make, and you just do a little bit of simple math. But the bottom line here is this is the kind of volatility that you're looking for. You're looking for a stock that's moving up and down, even if it's a tight trading range. This is General Motors. This is an older chart from earlier in the year. And this volatility, of course, creates the premium. It creates the amount of money that you will be paid. And you also want to look for liquidity, meaning you're looking, it doesn't have to be 16. This is after the close, so nothing's trading. You're not necessarily looking for 1,600 contracts. You want a few hundred if possible, and you want a reasonable amount to change hands, and you want the spread between the bid and the ask to be somewhat manageable. And a GM, a nickel would be a lot. I mean, and $100 stock, the way options work, maybe a bid-ask spread of 10 or 15 cents. Because it's kind of important sometimes to use market orders. If you use limit orders, you're fine. But you want to look for liquidity. It's very important, because it also means if you have to roll a position, meaning if you have to buy back the original position because the stock went the wrong way and then sell another one for the next week, you want to be liquid. You want the trade to be efficient. You don't want to be penalized by having to pay too much to buy it back and not get enough selling the next one because there's a lack of liquidity, and the spread between the bid and the ask is too high. So liquidity is important because it generates the spread between the bid and the ask. You're looking for days to sell. As I said, I like doing it here Wednesday. I've been moving more to Tuesdays. Volatility is so low now. I've pushed some trades to Tuesday because there's more premium, even if the stock doesn't move, because there's more time value in the that's going to go away if things work out properly. But you can do it. I recommended in some of my advanced services some June 1s this week. I mean, 2.5 weeks. So you can do it whatever fits your trading style and whatever hits your income goals. But look for the days to sell and look at the liquidity also combined, because often you may have 500, 1,000, 2,000 open contracts for this week, but there may only be a handful for next week because it's traders and people hedging on a week-to-week basis. Now, selling weeklies, there's 4 different things you can do. Weeklies that expire that week. You can do weeklies that expire any week up to about 4 or 5 weeks, depending upon where you are in the cycle. You can create a monthly that's closed early, meaning, let's say at Gilead Sciences, which was at 111, you might want to sell $110 June. There's a big fat premium on it, with the intention of closing it 5 days from now, buying it back and spending the commission because of where you think it's going and because of that. So that in your own mind is a weekly, even though it says it's a monthly expiration. And then there are trades closed in a day. In my own portfolio, I do more calls than puts. In my services, it's almost all puts and options income blueprint. in the advanced coaching services, of which I have two. It's a mix of covered calls and puts. In my own portfolio, I have a bias towards trading calls, and I sometimes day trade calls. I've been in day trading. Let's use a term of 48 hours. I've been day trading American Airlines for, I don't know, the last 6-8 months, and it's just a cash machine. And there are things you can do by selling, which are infinitely preferable to buying in that kind of a situation. How does it really work? You know, what are the specifics? It starts with stock selection. I'm sure if you come to online seminars and training, it's charts, it's Greeks, it's parabolic, hyperbolic, do this on a Tuesday at 5:30 p.m. when the dog is barking kind of trades, all based on math and charts. And I'm not putting those people down. I'm not. I even understand what they're doing, but charting systems all change over time. Fundamentals don't. And I do use charts at the tail end of a trade, not at the beginning of a trade, meaning the beginning of what you need to do when you're doing this is stock selection. Because if you're selling a put, in theory, I know most of you it's not real, but in theory, you're willing to own the shares at that price. More importantly, when you begin with stock selection, it enables you to trade, meaning to sell more aggressively. If you believe Blackstone, best financial management and publicly held private equity firm in the world, if you believe the company is great and the stock over time will go up, you can be very aggressive in selling puts and calls, and if you have to roll to another week or if you have to accept shares and turn around and sell calls, you don't care because you're managing a longer term position. It lets you generate much more cash and income on a week-by-week basis. And you're looking for great companies and great stocks and options with great premiums. We call it a bullpen. I have a bullpen of 25 companies for 25 stocks, and with the exception of all of them have very, very, very ripe premiums, meaning you can trade them almost every week or month and hit 25% or more annualized income goals. The two that aren't are Goldman Sachs and Boeing. You have to trade them around earnings. They don't get that kind of premium until you're starting to build up to earnings and post-earnings, because post-earnings there's a lot of volatility as well. But of actually there's 26 names in the bullpen now, and the bottom line is you're also looking, part of your stock selection has to be the quality of the option that you're going to sell. Are they typically liquid, and do they typically have enough premium for you to hit aggressive income goals? So if you're choosing between a Gilead Sciences and a Biogen, first of all, Gilead's a better company with a better product mix and is more profitable. But let's say they were perfectly equal. Gilead would be the clear-cut winner because of more volatility and far more premium when you're selling a call or you're selling a put. And it has weeklies. Now, we're in a stock picker's market. This is the most stock picking friendly market in 25 years, and that's an objective evaluation. Meaning the way that, in my view, the data that shows we're in a stock picker's market is that how many stocks in the S&P 1500 move independent of the indices within a fixed period of time, meaning a 1 to 5 day period. And it's going to generate, meaning if the indexes move up 2%, half the stocks don't. They either move 4% or they go down or whatever. It's a dream for this approach. This is and I believe we'll be in a stock picker's market for at least another 5 years. And when you get the company and the stock right, again, you trade more aggressively. So you can stock pick. It means, even though I think I'm smart, you can use multiple sources of stock information to be able, once you learn how to do this, to craft your own trades on top of the stocks that you like. So back to the question, let's walk through some weekly positions. We're going to do some older positions, and then later on near the end of the presentation, we'll do some very, very recent positions. This is from February, and Skyworks Solution is a company that's a lead supplier of what is known as RF technology. They're a supplier to Apple big time. And this is the kind of alert that is sent out. This isn't the whole alert. We couldn't fit it on the screen, obviously. The trade opened on February 4th. It expired worthless on the 6th. 100% of the cash was yours, and you kept it if you went into the trade, and there was a trading range of 45 cents to 65 cents, which means $45 to $65 a contract. So let's say you got it at 65. If you take a look at this, the recommendation is 81. That was in February. Skyworks is over 100 right now. The other value in this approach, again, whether you use my picks or your own, if you're doing this correctly, in my service, the stocks vastly outperformed the S&P 500 over the last 4 years. There's no comparison. And so you're combining existing skills and existing information sources on stock picking with this approach. So you get instant cash, $65 a contract. You transferred the risk to the options buyer, the sucker, as I call him. You needed $8,100 in capital in the unlikely event that you would put the shares. So in a tiny account, a $10,000 account, with all due respect to people managing $10,000 accounts, you would generate $65 in cash before commissions. The options expired worthless. There's no commission on the back end. That's a 0.8% return on capital in 3 days. That's that 0.5% to 1%. Well, folks, 0.8% times 50 is 40% annualized return. And this is a higher capital obviously required. If this was a Blackstone trade and the stock was in the mid-30s, it would have been, let's say, if it's a $35 put, it would be $3,500 per contract. So that week, we traded the 81. We sold the $81 put because the stock was trading right at 81, but it was an upward trend. What I do, and again, because we have more time, this is not normally something that there's no slide here for it. When you're trading weekly options, the key technical indicators are not technical. What they are the 3, the 5, and the 10-day volume flows into the stock. And what I mean by volume is shares transacted at what price. So when you're trading a weekly, let me repeat, the 3, the 5, and the 10-day, where does the most activity happen? Where's the ceiling? Where's the floor? But specifically we're selling a put, where's the floor? And the floor here was between 80 and 81, which meant if you sold a 60, you got 65 cents, and you would put the shares, you were going to have a break-even and cost basis. More importantly, it's very liquid. You could have rolled it into the next week, meaning bought the position back and sold another one. But that's the technical indicator when you're doing weeklies. Monthlies, you have to bring in moving averages. But when you're selling weeklies, it's the 3, the 5, and the 10-day share volume at what price. And that's very, very important. If you see something bouncing around and over the 3, 5, and 10-day periods it consistently bounces, let's say off of 81, it's a great place to sell a put that expires in 2.5 days, assuming there are no events going on. Now, obviously, because it expired worthless, Skyworks closed significantly above the $81 price point. It expired worthless, and you kept the $65. And that's one trade. If you had a larger portfolio, 2, 3, 4 trades a week, or multiple contracts per trade, you can see how the math is in your favor and the cash begins to add up. And the answer is, can you do it on a regular basis? These are the trades closed in my service. I did this in preparation for this. May 15th was last Friday. So this is what happened if you assume 3 contracts per trade. And it's for illustrative purposes. It might have been 1 contract, but you can do the math yourself. This is a different Skyworks solution put. This was not obviously the one in January. And this is what we did. It's just our track record. These are the closed positions. There are some open positions in the service. These are the ones that were put on. And 1, 2, 3, 4, 5, 6, 7 of these were weeklies. American Airlines was a rolled position. It had lasted we closed it within a week. So all of these were closed within a week, which is rare. Usually some monthly that had been going on would have been closed. But I usually close monthlies early, and I've been closing them very early now because there's just a lot of money has been made. So, for example, Grubhub, and the symbol, by the way, I apologize for leaving it off, is GRUB. Grubhub, we closed the day before earnings. We had sold the $45 put, and it's a very volatile stock. It's not typical of, it's a disintermediator. It's a national, you order your food service and someone else delivers it, and it's been growing 60% a year. It's a real company. It has profits. But it's, it bounces around, has a huge multiple. It's not the typical stock I like to trade. So we closed it the day before earnings, and we had sold the $45 put, and we bought it back. So we had to spend some cash to buy it back, but we made $75 a contract, which was fortunate because the next day the street didn't like the earnings and the stock dropped $5. So these are not automatic positions. You have to keep an eye on them. But so that was closed in a week because of the earnings announcement. It was a monthly position, meaning we'd sold a monthly option. And the Tesoro buy right means we bought the shares and sold the calls. And that may have actually been more than a week. That may have been 2 to 2.5 weeks. So it's 7 out of 8 were weeklies. And that's something we closed early as well. Tesoro is an independent refiner in the Northwest and Central. Now, the stocks you should consider doing this for right now, because of a combination of company fundamentals, the movement of the stock, and the availability of premium, here they are. Apple, American Airlines, Blackstone, fabulous company, pretty decent dividend too. EOG Resources is a very profitable, believe it or not, well, it's a profitable, not very profitable fracker, and the lowest cost fracker, meaning developing shale oil in the country, if not the world. Expedia, Gilead Sciences, which I think is the best company, I'm not exaggerating, it's my own opinion, and best stock in the world. Grubhub, except don't do a position going into earnings, but huge premiums. It's back above 40. It had drifted down to 38 and change, and you can sell. There are only monthlies available, so you have to be prepared to close them out. And Tesoro, the only one here, two that I don't own are Expedia, which I have owned, and Grubhub, which I have owned. But these are the ones that I would take a look at right now. In my service, we do this. I write an update every Monday in addition to all the trades, and I try to keep people abreast of what I'm thinking. I do trends, meaning I do trends different than Wall Street's. I have a trend called the New American Kitchen, which is the whole food revolution, and Wall Street is missing, is that people that are in the 50% income group are buying food and devices in Williams-Sonoma that normally were bought by the 20% income group. And Wall Street hasn't figured this out yet, so you try to get ahead of them. And in fracking, we did 3 plays this morning. One was a refiner, one was liquefied natural gas, and the other was Expedia because of the impact on travel. So you do your fundamental research, and from this, I just wanted to offer up to you today. These are names to consider. 7 of the 8 have weeklies, and Grubhub can be traded weekly if you're going in and out of it, and you're willing to pay a commission on the back end. So let me give you an example of thinking in stock selection, which I think is very important to this, is why would you do Gilead? Now, I prepared this last night. Some of these prices might be off. But it's the best in class by an order of magnitude as a biopharma. It has the first and really the only, because no one else is buying the other one, hepatitis C cure, not treatment. Totally misunderstood on Wall Street, and it's finally breaking out. It's selling at a 50%, that's 50, discount to the S&P 500 despite being on track to do 20 billion or more. I mean, gigantic market cap. This isn't a little biotech. It's the world leading provider of HIV drugs as well. They're great premiums on weeklies, and I'm using this as illustrative of my thinking. These numbers may be off because I haven't looked at the market for a few hours. But on Wednesday, you might be able to sell a $110 put expiring on Friday. You might generate 75 contract. That would be about a 0.68 absolute return and a 35.5% annualized return. That's the way you have to think. This is the flow of your thinking to pursue this kind of strategy. Great stock, misunderstood stock, fabulous fundamentals, and then off the stock, you're going to generate cash and income. Now, if you own the stock and you sell calls, rolling calls forward, which we can't cover here today, is the best thing in the world because it means you're making money on both ends. You're making money from the call, and you're making money as the stock appreciates. Here's another example of thinking. Blackstone 2 is best in class. It's a fast-growing dividend stock. It's viewed by some. I view it as a growth stock. It's breaking out again. It's hitting, probably going to hit a ceiling of 44 to 45. Tremendous momentum, but tremendous company, and they're the largest owner of homes in the United States that they bought at the bottom of the crash. Just started a $10 billion energy fund to buy up fracking assets that people may be abandoning. Spun off, they owned Hilton, went public December of 2013, owned La Quinta. La Quinta came out public, I think, a couple months after that. They're slowly liquidating their shares. The whole desire here is to return money to shareholders. And again, this would be a sample kind of way of looking at it. This is the typical position you would see in Options Income Blueprint, our core service. Fabulous service. I love it. I'd love doing work for it. And you're going, I'm not going to do this for $32 a contract. Well, you could do 3 contracts, folks. That's almost 100. and 100 a week is 5,000 a year, and that's on putting up capital of, not a lot of money. Three contracts would be $13,000 in capital. So you can see how this 1.5 to 1% target return a week, how it happens. This is how it happens. And again, let me repeat, this is the win rate, and our last survey showed that 93% of the people who subscribe make money. 93 out of 100. And no comment about the other 7%, but often people will see a stock move the wrong way. They'll immediately liquidate the position because they have a trader's instinct, or they're trying to protect capital, and the bottom line is they made a mistake. They have to wait for my alerts, how to manage the position. When the oil price thing hit last October and the market was down 5 or 6%, one guy liquidated all his positions and took big losses, and it turns out every single one made money. You had to be a little patient for a few days. We rolled a couple of positions and made a lot of money. An example of what happens, again, because I have more time here, but I want to start accelerating so we can get to questions, is when the first American Airlines trade we put on, a terrible thing when the Russians murdered all those people on the Malaysian airline jet. They shot it down. All the airline stocks sold off reflexively for 2 days because of the lemming idiots on Wall Street. And they really are lemmings, and many of them really trade like idiots. Doesn't mean they're idiots, but they're idiots. And we had to roll the position, meaning we bought back the put we had sold and sold another one for the following week. We made more money. We knew it was short term. We believed in the company and so forth and so on. So that's a winning trade. So even though the transaction, the first transaction we had to roll, it's 2 transactions as the position, and that's the win. And 98% of the trades make money. They just do. Since I started with your service, I've made 97 trades, 96 have been profitable. I've never had the guts to ask them which one wasn't. I can probably know what it is. It's probably Cree, but I didn't ask. And remember that 0.5% a week is 25% a year. That's how I get started. Let me show you what my service does. I've completed inside the service. There's a really wonderful training program. It's many modules. You can do it in bite-sized pieces. You can do the whole modules at a time. It's between 6 and 7 hours, or you can just pick off a half hour. And it's designed for investors of any level of experience, obviously. You wouldn't have to take the basics on puts and the basics on calls, but you might want to know what a double dividend trade is, or you might want to know how to roll a position properly and get the most money out of it. And we have different training videos for each one. It's all part of the price. And today, this is an interesting situation. There's a special training course, a tripwire training course that we do. It's 90 minutes. It's this like 1/3, the last part of what we're doing here today, with a lot of beef, a lot of meat, not a lot of gristle. And it's really about the right way to sell weekly options for instant cash, the 4 keys to selecting the right stocks, which is so critical to weekly options. It's a 5-point checklist for picking the best strike price, the best contract, the best way to execute, and it's how to prevent losing trades, which is probably to many of you more important than anything. There's a companion guide, how to sell weekly options. There are cheat sheets and little guides you can print out and as you walk through things in case this is totally new to you. All the slides from the training video itself, and a full recording of a recent live webinar, which I do. I do these live and I do these canned. This is for a recording. There is a recording of a recent live webinar, which is kind of fun. It's all $7.95. Now there is the link. It's optionsincomblueprint.com/WPT, weekly paycheck training. It's wonderful. And the reason we sell it for $7.95 is obvious. We want you to get acclimated to this. And if you see that selling weekly options is for you, you may come back and say, I want more of what you do. But it's a real training program. This is not glitz. This is a really, really solid, terrific 90 minutes. And it's www.optionsincomblueprint.com.wp. I hope that the link will be floating around somewhere. And this is, what we do there. Oh, excuse me. I just lost this. And there are a couple of other positions that I want to go to that I want to review. And what I'm going to do is call them up in detail. I assume you're all seeing my screen, so you can see me embarrass myself here. Let me go here. Well, you know what I'm going to do is I'm going to start taking questions, and 10:48 a.m. Nope, that's the wrong alert. Sorry, I'll close that down. What I'm going to do is I'm going to start taking questions, and I have to open up the box here. Let me go back to this. Let me go back to the link that you can take a look at. Now, you'll have to bear with me. Now, wait a minute. Okay, hang on a second. I'm sorry. I apologize. There were two versions of this open. Let me get back to this. That's why I stumbled. And again, let's get back to what you get. There's the weekly paycheck training course, because I had some other examples I wanted to go over, and I rushed to be here at 1 rather than 1:45, and I must have called up the wrong one. You get the recorded version. Well, let's go back to this. With the training course, you get the weekly strategies, you get the cheat sheets, you get the selling guide, and you get access to the website. What you also need is you get the live training and Q&A session and the complete PowerPoint presentation. And again, it's $7.95, and frankly, that's less than the cost of 2 double lattes at Starbucks. And you can risk going alone. You can, do income on yourself or cash on yourself, or you can take this kind of approach. Now, right now, over 1,000 investors are doing this every week, and they're putting cash in their pockets every single week. Got this email this year, my trading account, okay, and many of you are traders. Most of it's due to your strategy. In tracing, I placed 14 trades selling puts and have 100% positive trades. This is not an anomalous situation. For the people who upgrade to my service, who use the service from taking this training program and decide to take the service, it all works, whether they're doing the trades on their own or they're following my alerts. So if you're struggling to get consistent income from your portfolio or afraid of sort of a low interest rate environment, you really have to consider this. It's very, very important. It's the best $7.95, in my opinion, that you really ever pay. I mean, for this 90-minute training program. And I look forward to teaching you. We're going to have Q&A in a few minutes, but now I want to share the additional trades I alluded to. And again, I apologize for the kerfuffle. It was the rush. I had 2 PowerPoint presentations open. This was last week. This was the Tesoro trade. This is the top half of what an alert looks like in my service options income blueprint. It's an independent refiner. It has refineries in the Midwest, the upper Midwest, the Pacific Northwest, and they acquired one, I believe, from Chevron about 2.5 years ago in Southern California. Fabulous company. And every quarter, they're using more high-quality fracked oil from the Bakken Formation. And they published the schedule of what that is. They're going from a 5% mix, because they have long-term contracts, to over 50. That is higher quality oil with a lower cost of wellhead and lower transportation costs. So every quarter, their operating margins are expanding. I followed it for a long time. It was the most frequently traded stock in options income blueprint in the January 1 to May 1 time period. And you can see in the alert, I said, forgive my lack of originality. The service is all about making money. And we traded 37 different stocks, which this is what I do for a living. You should be focusing on 5 to 10, but 37 different stocks. We made 85 trades were closed last year. 83 were successful, and Tesoro was one of the favorites. So this is the alert that goes out. It was trading at 88.50 on May 12th. So I recommended selling the May monthly because it's the 3rd week of the month. So it's a weekly, the equivalent of weekly, the $87.50 put. We collected almost $1. We collected 95 cents or $95 a contract. There was $8,750 of capital required. The stock itself, closed at 91.36. The position closed itself, it expired worthless, and we kept the $95. It's so typical. This is just so typical of what we do. And even if you just take the training and don't end up with me in Options Income Blueprint, this is something, in part, I think you can do for yourself. I might be able to help you more, but these are the kind of things that you can experience. Now, getting back to another trade, which is the week before American Airlines. I have a Brooklyn sense of humor. If traders are going to be dumb, take their money. American Airlines is trading down due to the rise in oil prices. The trading range is really $47.50 to $55. It was touching that. Let's go and sell the $46 puts. And the bottom line was trading at $46.60 on May 6th. If you looked at the charts, this is in a trading range for 6 months between $47.50 and $55. A lot of people now hedge their oil positions with airlines, and so we sold the 46s. We collected $70 a contract. It moved very quickly. So what did we do? We weren't going to wait. I wasn't going to wait and leave money on the table for the next 2 weeks. In 2 days, we closed it out. We paid $15. We made a profit of $55 per contracts. If you'd sold 3, it's $165. And that was a 2-day trade. So that shows the flexibility you have when you're taking this weekly options approach. It doesn't have to be a weekly option per se. You have in mind that you may get out early and do a monthly. So again, let me go back to this complete training program. It's absolutely wonderful. It's optionsincomeblueprint.com at WPT. And I think I'll take questions now. And I've never done this before, so I'm going to do my best to read the screen. Or if someone moderating wants to help out and read the questions, I would be really, really happy. But I'm trying to look in here, and I don't see anything. I'm not sure how to do this.
So, Michael, on your dashboard, you should see a couple different buttons that say webcam.
Oh,
audio,
questions. Here they are. Okay.
Yep.
Okay. And I just start scrolling. Okay. I'm scrolling all the way down. Everybody had said yes. I'll go from the bottom up. Is there a free trial? No. There's for the training program, it's $7.95. That's less than a tuna fish sandwich at Whole Foods Market. For Options Income Blueprint, there's a 2-month trial for $79. I think it's on the website somewhere, which would be optionsincomeblueprint.com. And on that, with that cert, you get access to everything in the service, the whole member website, the 8 hours of training, everything's there for $79. The training program is probably worth $1,000 on its own. But there's no free trial. It's a $79 trial for the service. For this, it's only $7.95 for this training program. What do you charge a month? Again, this is Linda asking the question. The free trial is $79 a month, and then after the first 2 months, it would be $79 a month, or you can pay for the year. And I believe the yearly. I'm not a marketing guy. I think it's $6.99. Options confuse me, to be honest. If I could lose, then I must purchase the actual shares for each option just in case. If you're selling a put, your risk is the stock going down. And I'm not trying to be funny, and I'm not trying to be rude. If you're afraid of losing money, then you don't belong in the stock market, because you're going to trade fearful. People who trade fearful lose money. They close trades too early. If you view a put as the same thing as being willing to own the shares at the strike price of the put, and in the rest of your portfolio you own shares, then you'll be perfectly fine. Meaning, if you sell a Bank of America put at $16.50 and you really like the company and the stock short-term and long-term, and you get put the shares, you turn around and sell calls, or you liquidate the position if the stock goes up on Monday or Tuesday or whatever. Remember, these are weeklies that we're talking about today. If the stock goes down, it's not going to go down. It shouldn't go down a lot. In my service, we occasionally do options around events. Not often. We do them in the advanced coaching services. We do structured event trades all the time. They're a heck of a lot of fun, and they make a lot of money. But in the Options Income Blueprint service, I try to avoid events and try to take advantage of the volatility created by an event, and then we'll sell a weekly or maybe a monthly after an event is over. But you talk about a loss. If you're afraid of owning stocks themselves, you're really in the wrong place, because you're going to, fearful traders lose money. If you like owning stocks, then there's no difference in selling a put than owning shares at the strike price of the put. What is the membership to get you alerts with entries and exits? It's called Options Income Blueprint. That's the name of the service. If you wanted to skip this training and go right there, there are offers on the website. It's optionsincomblueprint.com. We have a full customer service department. There's an 800 number if you want to ask people questions. Let's see. Don't you have an offer on your full service? The offer is the $79 trial for 2 months rather than a month is the offer. We want to try it but not commit to it yet? No, there's no free trials. This is what you should commit to, the $7.95 training program. It's 90 minutes. I mean, come on, it's $7.95. I can't. Do you avoid earnings? The answer is yes. In my advanced coaching service, we do structured trades, which is usually a deep in the money call around an event. Just to give you a taste of what, if you learn this and you join Options Income Blueprint, and then you'll be invited to what is called six-figure portfolio coaching. We teach advanced trading tactics, and one example is in Expedia. Their earnings were coming up. Now, some of you are going to get lost with this, but I'll go slow. It's such a fabulous trade for people who are experienced traders. Stock was around 79.80, and the event earnings were coming up in a couple of days. I recommended buying the shares and selling a $75 call, which means you paid $79.90 or $79.80, and you're going to be called out at $75. But the premium for that call was $8.30. So if you're called out, you have a $3.40 profit in 2 days. Why did I recommend that position, and why do I call it a structured event trade? It's because Expedia historically has sold off 10% maximum if they miss on earnings. And if you do the math, $79.90 minus the premium you got, $8.30, brought you down about 71 and change, which was about a 10% sell-off if we were, or I was wrong about earnings, which turned out to be very good, and the stock shot up when we were called out. That's not in the basic service, but the point is the selling of options can be as aggressive as the buying of ones with far lower risk. What is the price per year? It's around $700 for Options Income Blueprint. I've been looking at trading futures. What is the advantages between trading futures and options? If you're selling, I don't know anything about selling futures, so I can't answer that question. I can answer the question for options. You have radically lower risk in selling options than buying them. 85% of options expire worthless. If you take a position of trying to do 18 to 25% minimum and 25 to 35% maximum on selling options, the typical successful options trader may do 100 to 200% on a position, but typically doesn't do, I mean, the great ones don't do more than 40% a year. So how do you send alerts? Alerts come out by SMS text or by email, both, and they go out contemporaneously. So I've read an alert, sent it to the editor cleans it up, it takes a couple of minutes, and then it's broadcast. And there's a trading range because not everybody trades at the same time. There's a trading range specified. You may have seen that in the alert, the top half of the alert that I showed, that Tesoro, I think we recommended get it at 95 cents but go as low as 75. So that possibility is taken care of, that you would have a trading range in case you're busy and you can't get to make the trade, but it's by text and it's by email, and that's to open and close positions. Do you sell deep out of the money? Usually, I mean, you can. I don't do it personally because there's not enough money in it, but there's no reason not to. It's a very good question, and so why not? But you're going to make less money. This is a question from Julian, and by deep out of the money, let's say the stock's at 50 and you sell a $45 or a $40 put. If you're willing to settle for lower returns, let me stick back for a second. I consider the lowest possible returns in my service on an individual transaction, and I'm not assuming that this translates into what the yearly performance will be. I always shoot for the low 30s on an annualized basis. The average has been about 28 or 29%, and I'm assuming you can't make all those trades. So I'm assuming you're somewhere between 18 and 25% is your target income from this. If you want lower income, you can, if you become a member, just send me an email. I'll send you a list. They're dumb. There's so much dumb money in out of the money puts. It's frightening. So if you want to do 10% a year, you call them silly puts. You could sell these all day long and just ching away. And I don't see the need to. I think you should be able to do 18 to 25 a year. But if you're willing to settle for 10 a year, it's like shooting fish in a barrel. And this is remember in a period of very low volatility. Lost sound. What is the price per year? Do you avoid earnings? We want to try it, not commit to it. Well, trying it again. This training program is $7.95, and if you're going to try it, the trial is $79. Don't you have an offer on your full service? The offer is to try it first, and you get 2 months for the price of one. No free trial. Link, URL. What do you charge a month? Website address is optionsincomblueprint.com. What is the membership to get your alerts with entries? So options confuse me. No screen. Can you please copy the link here? Oh, type answer. http://www.options incomblueprint.com/WPT. That's for this trial program. So there it is. And can you sell them in an IRA? Yes, this can be. I do this in my IRA all the time. Again, you may need maybe you can fill out a little piece of paper that gives you permission. If your broker gives you a hard time, there's something wrong with your broker. I don't know of any brokers that prevent you from doing this. Do you like Options House? We don't express opinions on what we do. There's a list on our website of brokers that people have made comments on, and every month in the full service, that is, we do a live strategy session. It's just usually 1 to 2 hours give and take. What do you think of this stock? What do you think of this tactic? And one of the things that always comes up is people start chatting with each other. It's sort of a community. It's kind of cool. And one of the things that always goes around is commissions and broker execution. I personally use Options Express. It's not the cheapest, but I've been using them for many, many years, and I love their ergonomics. And even though they don't get rated highest overall, they typically get rated for the best ergonomics. Size portfolio. This can be 10,000 to 10 million. It really, well, 10 million might be a stretch, but I have $1 million customers that I've met in person. We went to Florida, and now we'll probably do twice a year. We do in-person seminars. We invite people in, and we have a great time for existing subscribers. We had a blast. And it was all these faces of people I hadn't met before, and I'd been doing emails with them for years. And some had very, very considerable portfolios, and others had small. And it would be, $10,000, you're going to have to be really careful and pick and choose your spots. But once you get maybe the $20,000 range, things you can do several positions at a time, it gets a lot easier. Was Vincent Vora canceled? I guess the answer is yes. There's a question about selling weekly puts. Is this a training program or giving specific entries and exits for busy people? The training program is just training. Options Income Blueprint has the specific alert information, meaning you get a specific alert on your text or on your email. This is what you should do. And then if you're going to close it, we send out the same thing. And on Fridays, because we're all forgetful, we send out a reminder that says, oh, by the way, this is going to expire worthless. Just thought you might want to remember. Are you part of the Millionaire Blueprint group? Traders Reserve is my publisher, and Traders Reserve publishes Millionaire Blueprint as well. And what if you don't have enough money to cover more than 1 or 2 contracts at a time? Again, that goes back to portfolio size. And it's really your portfolio size. I mean, let's say you sell Blackstone and you sell 2 contracts, and that would be right now probably $8,800 or $9,000 in capital, and depending upon a monthly or weekly, you might be able to generate $60 or $70 after commissions. So you can do your math from that. That would be a 30 to 35% annualized return. It really is a portfolio size, and it is important, by the way, when you're doing weeklies with a small account, to have an efficient broker, to have a broker that's a low-cost commission broker. Let's make no mistake. Please give a typical example of a loss amount if the stock is already owned but the option needs to be paid out. Huh? Please give a typical example of a loss amount if the stock is owned already but the option. I'm assuming that the person is suggesting a call was sold below the cost basis of owning the shares. That's not happened in my service. So I don't know what to say. I mean, what happens is about once or twice a year, we had 85 trades open and closed last year. 2 were the same, which was CRE. We've had a tough trade this year in U.S. Steel. It started last year, I think, but we didn't close it. After 3 months of rolling them, and usually if it's really a bad, these are both around earnings, by the way. These are the classic earnings positions that I really don't do many. And in the alert, there's a big warning that said this is an earnings position. With CRE, it was after 3 months we said, if you accept shares, I will follow the stock and we will sell calls. And when I put out an alert about what call to sell, I talk about the cost basis and what the cost basis and how it's being reduced over time. But that's the closest I can get to answering your question. I don't take losses on stuff like this. We typically have 1 to 2 positions, and I'm not exaggerating, out of 90 or 85 a year, which head south. Last year, it was the tail end of a Whole Foods trade, and CRE. This year, it's CRE and U.S. Steel are the 2 that are pretty deep underwater, and that's typically what happens. And with weeklies, it's very rare because we don't do weeklies around an event. It's a very rare occurrence, and weeklies are, if I ever do an event trade, maybe 1 a quarter, 1 every 6 months in Options Income Blueprint. I do them in a very different way in the coaching services. We're very, very careful, and there's all sorts of bright flags in the alert going, remember, this is an earnings announcement. Does TD Ameritrade? Yes, you can do this in an IRA. I signed up. Is there a link material later? Yes, customer service will get back to you and send you emails about login. I'm looking for a higher probability large portfolio income. Don't understand what the question means. Julie, if you could repeat the question, I'm looking for a higher probability large portfolio income. This works with any size portfolio. If you go to Options Income Blueprint, although we've started taking people who've never taken Options Income Blueprint services, we have something called 6-figure portfolio coaching, which is once a quarter. And I'm almost at the end of this quarter, so we do it again in July. And it's designed for larger portfolios if that's of interest. You can just contact customer service and they'll send you information. Do you sell deep out of the money puts? I think what if the stock gaps down big? With weeklies, it doesn't happen. And it depends on how you define big. With monthlies, it can happen. For example, with SanDisk, and this was in a coaching service, not in Options Income Blueprint, they pre-announced. So they pre-announced their earnings about 4 or 5 weeks early, and the stock really did gap down. Well, there are 2 things to do. You roll the put and hope that it's a market overreaction, and you roll it enough times, and then if that's not working and the stock is not bouncing back, you would obviously have to accept shares or take a loss. And if you accept shares, and I always recommend this for deep underwater, you generate cash much faster than rolling a put. And let me explain what I mean. If, let's say, you sold a SanDisk $85 put and they pre-announced and the stock goes down to 70, in a heartbeat, and your $85 put costs $17 to buy back. If you move it from May to June, you're not going to generate any extra cash. It's going to cost you $17 to buy it back, and you probably get $17.20 to sell 1 a month out. However, if you accept shares and you sell calls on a weekly or monthly basis, with a highly volatile stock, especially after earnings, you can generate 50 cents to $1 a week. And you start nibbling away at how deeply underwater you are. It requires patience, and it requires the willingness to sit on capital that isn't necessarily producing a good return for an extended period of time, for months, not weeks. But I have no memory of this happening with weeklies. It may have. I don't want to give you false information. We may have gapped down once, big time, on a weekly position. It's happened on monthlies, but in fact, even though U.S. Steel is a problem now, many years ago, 3 years ago, U.S. Steel was the most successful roll we ever did. And the typical aberration in a weekly is the American Airlines trade that I described. We put it on a Wednesday. The Russians murdered those people in the Malaysian Airlines trade on a Thursday. The stock cratered for a heartbeat. We rolled the put into the following week. We bought back the original position because of volatility. We actually got a better deal on the one we sold in the following week. The stock bounced back, and we made more money. That's more typical with weeklies. One of the reasons that people prefer weeklies, besides the weekly paycheck issue, is the lack of exposure to market events, which is really, really good. How was your gain record in 2008? This didn't exist in 2008, and by the way, I was the #1 advisor in the world in 2008 because I ran a short service, and that's not an exaggeration. I ran a service called, shorting stocks. I got into shorting regional banks and got into shorting the home builders in February of 2007 and started shorting the big banks, thanks to Meredith Whitney and being in the green room getting makeup on in Fox Business with her, the big banks, and we had 21 money doublers in a row when the market crashed. That's a speculative service. We gave it up because shorting disappeared after Ben Bernanke announced quantitative easing. And by the way, the beginning of the market rally was March 9th of 2009. That was the day my book Sell Short was made available on Amazon. So timing in life is everything. But no, I was the #1 advisor that I know of that was, we didn't publish information, it was Phillips Publishing, but trust me, it was 21 money doublers in a row. It's pretty hard to beat. And it was like shooting fish in a barrel. Shorting the banks was so easy to do because you could go to a website that had the cost of their swaps, and as the cost of their swap agreements went up, you knew that people were going to short the stock, and we did them in sequence. It was an amazing period of time, and unfortunately, sort of by policy, I wasn't allowed to short anything that I was recommending, so I made royalties and nothing else.